It's time for Operation Freedom with your host, Dr. Dave Janda, on Southeast Michigan's conservative powerhouse, Wham Talk 1600.
Welcome back to Operation Freedom, folks. I'm Dr. Dave Janda, broadcasting from our Freedom Bunker here at Wham Talk 1600. If you missed the first hour of this show, well, it's going to be available by podcast for our subscription members by 7 p.m. this evening, thanks to my wingman, Derek Stone. We discussed the deep state, the Mueller report, the fact that, we've yet to get a apologetic phone call from any one of those thousands of people over the past 2 years that have denigrated me, harassed me, threatened me about my stating that the Mueller report would show that there was no collusion between Donald Trump, his campaign, and the Russian government. Yeah, we discussed the Mueller report in the first hour of the show, also about Benghazi, and the link that the same individuals that were telling us that Benghazi was, well, it's something that should be swept under the rug and was really nothing more than about a YouTube that went bad. Those were the same people that were telling us that tried and will continue to try, unfortunately, to remove a duly elected president of the United States. Those are the same individuals that are not only guilty of treason when it comes to Benghazi, but also guilty of sedition when it comes to removal of a duly elected president of the United States. As you know, one of the topics that we focus on quite heavily here with this platform is your financial freedom and your financial well-being, and providing you information that the bought-off lamestream fake media, including Fox Business News, CNBS as I call it, Reuters, and Bloomberg, will never provide. One of our valued guests on this platform is TraderStef, and that is a name de plume, and the reason is because of her background, as you'll hear in her introduction. Beginning in 1996, TraderStef initiated a career spanning 14 years within the New York City investment banking industry. She acquired a diverse skill set in human resourcing, technology communications, training, education and development, business analysis, and global risk. She began investing in precious metals in 1999 while following market trends post-dot-com bubble in 9/11, and Steph then left the banking industry in 2009 after 5 years in global risk management at Citigroup. She now is a very prolific writer, a very prolific analyst. You can follow her information at www.traderstef//WordPress.com. She also is very prolific on Twitter as well under the moniker TraderStef, S-T-E-F. Steph, welcome back to Operation Freedom.
Hey, Dr. Janda, how are you today?
So I'm doing a little revved up. I'm a little disappointed. Here I thought all these deep state zealots that had been threatening me, screaming at me for the past 2 years about how I was misleading people, about how the Mueller report was going to lead to the impeachment of Donald Trump, and that I was stating that was not going to happen, that it would exonerate the president. I've been waiting for them to call in and apologize, and I haven't got one call, Steph, and it's very heart-wrenching. It's very disappointing.
Yeah, I don't get any "I'm sorry" calls from gold trolls either. So
well, let's talk about that. No, let's start on that, because you, as I mentioned, have been involved in the financial industry for years at a level that at a very high level, and in particular, you identified precious metals as far back as, and you can tell me if I'm wrong, 1999, as far as the importance of them in an investment category, an investment portfolio. But there's so much misinformation out there about precious metals. Why don't you take us through where we are right now about some of, let's call it the fake news that's being promulgated when it comes to gold, silver, the precious metals market, and then let's go into your analysis of really where we are and where we're going.
All right, sure. I've coined the term price derangement syndrome, to take on Trump derangement syndrome. You can relate to that.
Oh, yeah.
But there's always news coming out. But the manipulation meme, really got under my skin a few years back, particularly after I saw the price of gold fall in 2013. So I really wanted to try and figure this out and see what was really going on. So there's constantly these news items coming across my screen. And when I do a little research, I find that, that's not really necessarily what's going on. So it's evolved over several years. Most recently, there was a news item that came out, and it was reported on February 13th, but it actually happened on February 1st. So that's a full 2 weeks before pretty much most folks even heard about it, including myself. And the ICE, which is, ICE, otherwise known as the Intercontinental Exchange, and they're basically the global leader in electronic trading. They facilitate the electronic, wires across the globe. Mm-hmm. And on February 1st, they noted that they were going to implement a passive order protection functionality, otherwise known as POP, P-O-P. And basically what that does, it would insert a few milliseconds speed bump, basically downtime, into high-frequency trading and algorithms in the gold and silver markets. Mm-hmm. Now, high-frequency trading is like a huge topic I don't want to get lost in because we don't have much time. So if anyone really wants to explore that a little bit and have some fun with it actually while you're doing it, go to YouTube and type in this search term, Flash Crash Documentary. And within the first page of results, you're going to get two videos that will come up. One's called Flash Crash 2010, and the other's called the Wall Street Code. Go watch those. So back to HFT with ICE trying to cause delays within the gold and silver futures market. Now, the meme in the article that came out on 13th was it was used to stop the manipulation in the gold and silver market. Well, it's important to note that these POP speed bumps have been put into place, in other markets across the globe in all asset classes. This is not gold and silver specific. And it's not necessarily the usual behind-the-scenes manipulation meme you hear in precious metals about the guy behind the curtain that's trying to keep gold down because the central banks and, it just gets so complicated. That's not really what it's about. The electronic trading platforms have changed the trading environment. 85% of most trades are electronic trades that are not executed by humans. And decisions are made by these computers, too. So when this ICE report came out, there was a big deal made about it. Now, what nobody heard was that same night, the Commodities Futures and Trading Commission, the CFTC, decided to put a stay on that ruling, the POP implementation. And they were going to wait for 90 days until May 14th, and they wanted all market participants to post at the website, their complaints or the pros and cons, and then it'll be reviewed. So it actually hasn't even happened yet in gold and silver. So that's important to note. I'm also going to note that within the participants who are posting their comments at the website, at the CFTC, both on the pro and the con, one of the largest liquidity providers, which is Citadel, for electronic trading, they've noted it's actually going to increase the potential for manipulation in the market for things such as spoofing. And if anyone knows what spoofing is or you don't know what it is, that's when they put fake bids up on the screen that get taken back down in a millisecond to make it look like the price is going in another direction than it actually is, and then they profit on that by getting on the other side of the trade. So that's a form of manipulation, but it doesn't fit into the comfortable little basket that the precious metals manipulation meme tends to fall under. It's a market-wide problem that happens everywhere. So now let's kind of skip to...
Well, so there's a lot of people right now, Steph, that thought, as of like February 13th, February 1st, the markets, there's less vulnerability for this manipulation because this POP has already been put in place, when in fact, nothing's been put in place.
No.
All right. So let's go on. So let's take the next step. Let's look at where we are in the precious metals world with gold and silver. Because to me, and you can tell me if I'm wrong, but the gold and silver markets to me have been acting differently in the past several months as opposed to how they had been acting for several years. Am I wrong on that?
No, you're right. They're acting better than they have, and they've been acting better since December of 2015.
So let's look at, because one of your, you are a technical analyst extraordinaire. So where are you with your technical analysis of gold and silver? Because a lot of folks that listen to this show and come to the DaveJanda.com platform have saying, wait a minute, the reserve currency of the world, the dollar, is not backed by anything tangible. I need to put my eggs in a real money basket with gold and silver. So they're interested in what's happening in those markets that you're picking up, that 99.9% of folks have no clue that's occurring. Where are we, Steph?
Right. Well, technical analysis just doesn't apply to traders. It also applies to the guy out there, the retail investor who's looking to invest in some coin or some bullion. And, you don't want to be buying at the top of a rally. You want to be purchasing at the lowest price possible. So you want, a low risk, high reward. So I encourage everyone to pay attention to technical analysis, at least good technical analysis. Now, ever since the low we put in August, we've had a really nice rally of almost $200 an ounce. And during that rally, I've identified 3 sweet spots. So, prices don't go straight up. When they do, that's a problem because they're going to fall as hard as they went up. Right. So it's been a nice, steady kind of staircase that we've had here. And within certain parts of that staircase, there's been a nice rally for $40, $50. And I tend to identify those as sweet spots. So when we got up to a high on February 19th, it was, let's see, what was that high? We put in a high of 1346 and some change. I put out a note on Twitter that, are you happy with the most recent sweet spot? Because you might want to consider taking profits here and don't wait for my next article to come out. Mm-hmm. And lo and behold, that next day, when you look at the chart, you've got candlesticks, which represent a price. And different candlesticks represent different ways that the price was acting for that particular day. One of the candlesticks that come out at the top of a run that are an indication that you better pay attention the next day because you're probably going to get a pullback, and that's called the doji. So if you think of the symbol of the cross, the Christian cross, but just take the horizontal part of the cross and just move it down a little bit like in the middle. And sometimes that part can be a little wider, a little thinner. That's a doji. That means that the price closed and opened at almost the same price, but it had a much higher high that day and a much lower low. So that's called your doji. And we printed a doji on that day. So that evening I put out an article and noted what was potentially happening. And lo and behold, the next day we had a $25, almost $25, I think it was $23 correction. And, forget about it. Then the gold trades come out. Everyone's freaking out. It's being hit. It's being manipulated. Look, everyone forgets about a couple weeks prior when it went up that much in one day. But no one was complaining, right?
Right.
So after that, we got that created 3 doji sticks, which is called an evening star pattern. So when you look in the sky, you see a star up in the sky. Well, it's like these 2 big fat doji candlesticks, and we've got this little doji sitting up there in the middle. It went way up there, and it's just hanging out, and then all of a sudden it fell. So it's an evening star. And lo and behold, we've had this pullback. Now, on March 5th, I sent you a direct message. Right. And I noticed that a lot of volume came in that day, down around $12.80, $12.81 an ounce. And I said, it looks like we might have hit the low here on this pullback. And, well, that's what happened. Over the next few days, we got another triple pattern on the candlesticks, which indicate a low. And we've retraced over 50% of that pullback. So as of Friday, I'm trying to look at the price here. I'm sorry. Hang on. We closed at $13.13, but we've been as high as nearly 13.15, 13.16. So we got to get back up into the 13.40 range. So right now what I'm seeing is that it looks good, but it needed to take this breather to put itself back together because it's been a really nice quick run since August, and we got a lot of overhead resistance to get through. Now, if you recall, back in early 2018, gold got up into the 1350s and 60s, and it bounced around for a couple of months. Well, that created a lot of lateral resistance up there. So we need this breather to, get its gumption back and get enough steam to be able to take out all those resistance levels.
And then what hit this week, because that brings us to the next point, is what the Fed did, right? The Fed that up until 2 months ago, you can tell me if I'm wrong, was saying, we're going to have 3 interest rate increases this year. And now all of a sudden have now backed down to, no, we're not going to have any this year and maybe one next year. Now, this is a huge change.
Yeah, I've been calling it the TaperCaper for about 2.5, almost 3 years, because everyone who's been following the markets could see it. They could only raise interest rates for so long because it was going to create a lot of strain in the markets. And what the Fed has fell into, they had to raise interest rates in order to have rates to pull back from once we went into another downturn or a recession in the business cycle. And they started raising rates very late in the business cycle. Really wasn't smart. They should have been doing it a few years back, sooner than when they did, which coincidentally was December 2015 was their first hike since the financial crisis, and that's when gold hit its low. So, but what they fell into now is a QE trap. And let me read that to you. That happens when the central bank has purchased long-term government bonds as part of quantitative easing, and initially the long-term interest rates fall much more than they would in a country without, a QE policy. And the economic recovery tends to come sooner, at least it doesn't keep collapsing, it just kind of levels out. But as the economy starts to pick up, the long-term rates begin to rise quickly as bond market people fear that the central bank will have to mop up all the excess money, in the long-term bonds. So then the demand falls in interest rate sensitive sectors such as cars and housing, which is what we're seeing. And it causes the economy to slow down, and it forces the banks to relax the policy stance. Boom, that's where we are. So now the economy starts to head toward recovery again, but as the market participants start to focus on the possibility that the central bank absorbing the reserves, long-term rates surge in a repeating cycle, and that's called the QE trap. So now, we couldn't even get to 3% interest rates when 5% used to be the norm.
Right.
And Europe, they went back to quantitative easing after only trying to do some quantitative tightening for, I think, maybe 6 months. So, and Canada did the same thing. Canada was the first to pull the trigger. Then it was the European Central Bank. Then we saw China beginning to slow down, whereas the tariffs and the trade wars were making it worse. And then the Fed finally came around to what was going on. Trump was right. He's not an idiot. He knows the markets.
So when you look at this, and then you add to the fact that, on Friday, I believe it was, Steph, that the 3-month Treasury yield was higher than the 10-year, right? And reportedly, that's one of the hallmarks for a recession to kick in within a year's time. Do you believe that's an accurate weather vane to utilize?
Every business cycle is different, but what I can say is since 1921, there have been 17 times when there was a significant flattening of the yield curve before it inverted, and they all preceded a recession. So now that we have the inversion, it's like the same thing that happened before the financial crisis in 2006 and 2007. We had, an inversion, but you have to remember that it's a lagging indicator. So the effect that we're having right now in the economy and around the world is what happened 12 to 18 months ago. So we haven't even seen the effects of the interest rate rises that we've had over the past year and a half. That effect hasn't come into play yet. So the Fed's trying to get ahead of the curve here, even though they're behind the curve, if that makes sense.
Well, and then you add to that the fact that central banks have been on one of the biggest precious metals, in particular gold buying sprees in, 50 years or so. And so we have central banks, we have sovereigns like China, Russia, India, a number of other countries purchasing precious metals.
Right. Well, look, if we put ourselves in Chairman Powell's shoes, the guy that runs the Federal Reserve,
right,
he's indefinitely pushing the pause button to blunt, some global contagion with a happy face, rather than focusing on the negativity that could be a self-fulfilling prophecy. So honesty from the policy hacks would cause the markets to crash sooner, the consumers would start stuffing their mattresses with worthless paper, and there'd be a loss of confidence in central banking to be able to maintain some sense of stability. But the Fed's doing it anyway. So, like Jean-Claude Juncker, the president of the European Commission, he said, when it becomes serious, you have to lie. Well, right. Look, central banks are hoarding gold at a record pace. Cash is king, and risk management is not just for banking geeks. So do as they do, not as they say. And central banks have been the biggest gold buying spree in a half a century, basically. And, we're seeing articles on Bloomberg, of all places, of buy gold, sell stocks, the trade of the century. Are you kidding me?
So when you look toward the horizon over the next 6 months, where do you see things going, and what should people do to protect themselves?
What happens with Brexit, actually, the British leaving the European Union, is a big deal.
It is a huge deal.
Right. That's going to break and come to some kind of conclusion probably before the China trade deal would. So both of those are weighing heavily on what the Fed is going to do or not do. But at this point, they basically put on the brakes. They're going to do nothing for a year. They're not going to reduce the balance sheet. They're not going to raise interest rates. So now we're just kind of floating along. But, the market still started to plummet at the end of the week anyway. And now we got political instability. I don't think because the Mueller report's coming out that it's over. I think it's just begun.
Yeah, because many people believe that once the Mueller report was submitted, it was clear sailing. And in fact, as you mentioned, and I've been chastised for this, Steph, I've spoken about the significance of the Brexit situation. And many folks have said that I'm peddling fear porn, that in fact it's not a big deal.
No, you're just a realist.
Steph, how can folks follow you and get information on a daily basis from you?
Sure. My website is TraderStef.wordpress.com, or go to my Twitter feed, give me a follow. It's TraderStef, TraderStef, like Francis.
Steph, I'd like to thank you for everything you have done, are doing, and will do. You truly shine the light of truth when it comes to financial markets and what people can do to enhance their financial freedom. Folks, you're listening to Operation Freedom. Dr. Dave Janda broadcasting from our Freedom Bunker here at Wham Talk 1600.